Beautiful. Good after morning. I I want to make a video going over the analysis and sort of valuation process that I do with stocks before I start kind of valuing and not valuing. I don't do valuations too much, but analyzing and kind of deciding if I want to buy or sell stocks. So I just want to make like a video that kind of goes over my process, um, what I look for, things like that. And yeah, okay. So I'm not going to do a webcam here just because I need a screen flexibility here. But I'm just going to start very basic from the beginning. I'm using Robinhood here as a as my example company. Um, One thing to note also, my video yesterday, I said Robinhood stock was going to drop to around $22. It's almost there. I did buy a couple shares just to get the lower price. But yeah, there's the chart. I bought somewhere around here. Um, yeah. But anyway, back to the actual video. So there's a few things I look for, a lot of things I look for actually. I'm planning on having like a whole system for it on an Excel sheet. So then when I go through companies, I can check off like um, solid long-term growth rate, target price over actual price, things like that. Um, so that's something I'm kind of looking for. So honestly, I think I'm just going to get right into it and just start with things that I want to see. So, like for example, no, what do we want to start with? No, yeah, weighted average cost of capital. I want to see at or I don't know below 11%. Below 11%. Which is usually most companies are right around 8, 9, 10%. So I kind of just do general rule of thumb to be below 11%. That seems to be fairly consistent with basically everything. Oh, you know what else I'll do? I'm going to go a step farther. Snapshot. So the software I use here is called FactSet. There's different things on each thing. So the snapshot is the first thing you look at. This is just a general overview of the company. So I'm going to do things on that page and then work my way down and go through that. And this will basically be a checklist, essentially. So target price over current price. This stuff, again, is very, very, at least in terms of snapshot. Some people might not know what weighted average cost of capital is, but this stuff is fairly basic. LT growth rate, positive, depends on industry. General rule of thumb, I want to say like 10% beating inflation. So obviously, Robinhood's long-term growth rate you can see right here is 100%, which is very, very nice. I believe that's it. A lot of people. One thing I will say that I always tell as many people as I can. A lot of people like to look at the beta. Beta means nothing. Beta is meaningless. It has no role or say in anything. It does not determine anything at all. I can't stand beta. I do not want to see beta. I could go into these growth summaries and say like the growth estimates and like is it positive and all that, but honestly, that's more of wow. Those are all very high numbers. I honestly don't know. Not that I don't know too much about it, but it's more like the things we'll see in some of the financial statements later will kind of go into this, so it's not really as important. But anyway, next thing is comps analysis. So really, I mostly just use this as like a general reference. So like, wow, what are these companies? I don't even know if I. Sometimes I use comps analysis as a reference, but honestly, with specifically Robinhood, I don't think I will. Mostly because other than like Oppenheimer, I mean they're a financial uh, planning sort of company and stock analysis, but none of these companies, I don't even know. So, all right, skipping that, we are going right to the income statement. Income statement, very important. Talks about the money the company makes and basically what it goes into. So, a lot of things you want to see: sales growing consistently, consistent sales growth, operating income, you want to see that going up and positive, growing positive. Operating income. All right, another thing. So like obviously I could say like there's a point of every single thing, like, oh, total expenses. I could put that and say that's what that's from. But you kind of understand that expenses are also important. But the key points that you want to look for are things like sales increasing, operating income increasing. Net income is very important, but again, I'll get into that again with the ratio analysis later. Positive, growing. So I don't really care what the number is for net income. That is one thing. Like, don't get me wrong, the number should be good. Like you can see here, net income is, I don't know what percent of sales, 188 out of 688. That's like 20 something percent. Very, very good. That is excellent. Um, EPS doesn't necessarily need to be growing. I would more say consistency is good. Another thing you want to see is shares outstanding. So I will put EPS as growing, but another thing I'm going to do later is assign number values to everything here and then have them all weighted based on how important I feel they are, and then come up with some kind of a number system that will kind of rate the stock based on everything. So that's kind of how the whole analysis thing is going to go. But for now, I'm just doing this part. So EPS growing, that's kind of another basic thing. Now, another thing you want to see is basic shares. Could do total shares too. It really doesn't matter too much which one you do, at least in my opinion. Now, generally, you want to see this decreasing. So let me actually kind of move that over a little bit. Yeah. You want to see basic or total shares decreasing. So, like for example, when Robinhood went public, 2019, they had 850 million total shares. Okay, if you fast forward to today, 884. Now, that's honestly not bad in terms of dilution. You could see a lot of other companies that will dilute themselves with more than double the amount of shares in a couple of years. That's very bad. In terms of this, considering Robinhood's a new company, they weren't making money for a while. You could see their net income, other than, oh, this is also in quarters too. You know what? Switch that to years. Um, you can see it's a little different there. But you can see their net income has been negative, other than 1 year where I'm assuming what happened there was just they whatever. But net income is negative. So I may just cut this part. I don't know where I'm going there. But anyway, you want total shares outstanding to essentially be going down. Now, it's not a bad thing if it does go up a little bit. Like, for example, this is an estimate, but we're going to go with the official 2023. 872 in 5 years from 850 is not bad. That is probably around a 1% change, maybe 1 or 2%. I'm not going to do the math right now, but you could also see it was higher last year and they repurchased stock and lowered the amount of shares. So that is something that is solid at the very least. Total shares decreasing or stable slash I don't know if I want to put like an exact amount or just I'll just put minimal dilution. Decreasing is very, very good. That essentially means the company is they're decreasing their own supply and increasing their own value. EBIT is essentially just like net income again. It's almost the same thing. So I'm not going to put anything for EBIT, but a lot of people like to look at that too. But I mean, again, like you can see 324, 290, it's a little different, but that's mostly just taking into account depreciation and amortization, which is whatever to me. I really do not care about that too much. So next up, balance sheet. This is kind of the one, not really the one. I would honestly say the income statement or the use of cash statement are probably my most important ones. But obviously the balance sheet is always important. So cash, big one. Ideally you want to see that increasing, but it also comes with the fact that as long as they are viable, like for example, Robinhood has $6.5 billion. That is much, much more than they really need to operate. Like probably, I don't even know what their operating expenses are, but it's less than that. Like whatever, selling general admin expenses, 658 million. The cash on their balance sheet, they have 10 years of operation just from the cash on their balance sheet. Something like that. It's not as important. So for that, I'm probably going to weight cash later as not as important as something like sales or net income growth, where like their cash, they declined a 1.5 billion over the last 2 years in cash, but also their net income ratio has doubled, which I'll get into later. Their net income has increased, things like that. So cash, don't really care about it that much. Increasing is good, but not. I'm just gonna put increasing slash healthy amount of reserve, something like that. In terms of total assets, you just want to see it increasing generally. Liabilities, generally you want to see liabilities decreasing. Obviously, it's really not the best thing when it's going up this much. So like for example, this is one of the, I would say, more major things with Robinhood. Is one of their concerns is debt. So for example, they have very little long-term debt, to be fair, very little, but they have 5 billion in short term, which is almost where their cash is. So in terms of, but again, also their cash can very easily cover their short-term debt. So what I'm going to do here is say short-term debt should be coverable by cash, something like that. Long-term debt is a positive that they have. Unfortunately, I'm not as accounting enough to tell you what other liabilities are. But they have 20 billion of whatever that is. That's a little concerning. But at the end of the day, they have enough to cover their short-term debt. That's really all that's pressing, like the most important thing. In terms of, oh, sorry, I did click on the tab. Debt. Obviously, you want to see decreasing debt. Liabilities, again, that is what I mean by debt, is liabilities. Equity, big one, retained earnings. So Robinhood has negative retained earnings mostly because they're reinvesting everything into their company. Um, and as much as they make, they spend on their company for aggressive growth. Now, it's a little different for every company, but for a company like this where it's aggressive growth, smaller company, it's not as important. But you do want to see a positive value. Growing, I would say that growing doesn't matter. No, yeah, I'm not even going to put it. Growing retained earnings does not matter as much as it just being positive. I mean, it would be good, but it's not as important in my opinion. I could go into book value per share. That's basically the worth of their assets compared to like the amount of shares they have, something like that. Um, Not going to. But anyway, I think that's basically it for what I like on the balance sheet. So let's go to the cash flow. Okay, so Robinhood, you should be able to see it right away. What's going on here? Their operating cash flow should be positive. That is the that is an estimate for 2024. Hold on a sec. There we go. Operating cash flow should be positive. That is what you want to see. I'm going to put operating CF. Positive. I could put growing too, but honestly, I feel like that's, oh my God, I'm pressing buttons. Growing, comma, positive. Okay. So operating cash flow, you want most of their cash flow to come from operations, obviously. In terms of investments, you can see they purchased a lot of investments in the past in 2023, which is the year we're looking at. That's not as important what the cash flow is. You actually would probably want their investment cash flow to be negative because that means they are purchasing investments, which really can, unless it's a bad investment, in which case it would still have like goodwill, cash value, which isn't all that bad. But I would actually say this should be negative, but I'm not even going to put it in here because it's not nearly as important as operating cash flow. Now, financing cash flow, I would like to see, you know what? No, I will put it in there. Investing CF negative. Okay. Financing CF. You do not want financing cash flow to be positive. You want it to be negative. That means they're repurchasing stock, doing some other things, paying off debt, which Robinhood has not done. In 2022, they did it, which is excellent in terms of them being a early aggressive growth company. So that's fantastic. The estimate for 2024 is also that they'll take out more debt, but again, it's not finalized yet, so I'm not going to use those numbers for now. But basically, you want that to be negative. Operating cash flow should be positive. Investing and financing cash flows should, in theory, be negative. Now, the fact that financing cash flow is positive isn't really the end of the world, but it's not the best. Now, free cash flows, positive, growing. Very basic stuff. You want free cash flow to be positive. Other than that, I think that's it for the cash flow statement. Net change in cash is kind of important, but again, like I was saying earlier, like it doesn't have to be increasing. This is just the way their cash changes, things like that. So this one is important. It's something I like to see. Okay, so it's not the greatest when it's the tiny screen here, but we'll get into it. Use of cash. So what you want to see here, again, I could restate positive cash flow, but really doesn't need to be restated. I mean, it's literally right there. So what you want to see is repayment of debt larger than debt issuance. Okay. So repayment should be larger than issuance. Um, I honestly really don't have a note for that. Oh, wait. What am I doing here? Consistency. Consistency is key. Should be larger than issuance. Okay. That just means they're paying off more debt than they're taking out. So you can see here, last year, Robinhood did not do a great job of that. The year before they did, though, which is fantastic. Obviously, 2021 took out a lot of debt. But in terms of their total debt history, it's not terrible, just considering how new the company is, in my opinion, at least. Um, and then another thing you want to see is repurchase of stock. It should be a negative number. That means they're spending their cash on their own stock, which is fantastic. And you do want to see that growing too, where they ramp up their stock purchases over time, but not as important. I think that's it for the use of cash statement. It's really the two major things I want to see. I want to see debt being paid off, and I want to see stock being purchased. Also, you don't want to see equity issuance. So, like you could see in 2021, when they added all that debt here, most of that was because of equity issuance. They were issuing their own stock. They issued a lot of bonds that included the debt, and they also issued a lot of stock. You really don't want to see that. That dilutes. That is what I was talking about earlier with the total shares. You do not want to see dilution. Now, if you remember the decrease I said, that is most likely from their big stock repurchase that they did in 2023, which is fantastic. You want to see that. So next, segment history. I'll go into that. So you could see Robinhood had a bit of a rough patch post-COVID 2022. It looks like they're coming back from it now, but you do want to see segment history increasing. One thing I don't like about Robinhood's financial statements, which I think if you look at this, you may be able to guess, is they have way too many segments. Like this one, other 41 million is a fraction of their cash. Like they could probably get rid of the bottom 6 here and just combine them into other, and it would make everything a lot easier. But doesn't matter too much. I'm not going to put anything for segment history here. I just like to see the growth. It's also nice to see all of their segments increasing. So, like for example, they had one here, cryptocurrencies. Now, me personally, I'm not a fan of cryptocurrencies. So the fact that their revenue is declining there, I kind of expect. It's not really a big deal for me. But what you do want to see is things like options and interest on investments increasing. That is important. Another thing, margin in interest. That's a big thing for Robinhood. I don't know what that means, but things like this. Cash sweep literally quadrupled. No, whatever it's after 4 times 5 cash sweep. That's fantastic. Equities went down a little bit. That's not really the biggest concern considering how much more their other revenues have increased. But yeah, I'm not going to put anything on the checklist for segment history there. Now, big one, ratio analysis. Basically, everything here is just going to be, is it increasing? That is the only thing I care about. That is the only thing I want to see. Now, I'm going to go to quarters for this because Robinhood had a rough year in 2022, and it would not make sense when they just had their first profit, which I don't know why I clicked on it. They just had their first profit last quarter. Actually, it might not have been their first profit. Yeah, they had a very slight one in 2020, but that was mostly because of lack of investment into their own company. But positive net margin. That is the first thing you want to see. You could say positive gross margin, positive operating margin don't matter when you look at the net margin. That's what you want to see. So that's what I'm going to put. Don't get me wrong, both of those being positive is good. Like if the net margin is negative, but the operating margin is continuously increasing and becoming positive, the net margin is going to be improving as well. So at the end of the day, that's the one that matters. So yeah, net margin increasing. Next up, I'm going to group these together because at one point in my life, I knew the difference, but honestly, I don't remember. So I'm doing ROA/ROE. And you want to see those increasing. This is basically how much money the company and the shareholders are getting returned to them for the investments. But they're not the same thing, just to be clear. Return on equity is arguably more important, which is nice because Robinhood's is increasing a bit further. Return on assets, it is definitely an important one, but for the life of me, I cannot tell you what it is, but I swear I'm educated. Other than that, I mean, some things you kind of look at, like all of these are important, don't get me wrong, but it's also the profitability and things like that are, again, mostly covered by the net margin. Like it's kind of a blanket term. If your net margin's positive and increasing, fantastic. Basic EPS, you do want to see that increasing, but we covered that earlier in the income statement. Turnover analysis. In theory, you want to see turnover, I believe, decreasing, but I'm not going to add that. It's not really the most major thing for me. Debt to equity ratio, you could have that too. I think I'll add it. Let me just glance over again. Oh, they also do, again, have the shares outstanding in here, just for the ratio analysis. Diluted shares outstanding, things like that. Again, 850, 884. That is not that crazy for a new high growth company. So no problem there. But again, I already have total shares outstanding, income statement, so not putting it again. So other than that, I think I'm good. And yeah, I will put. Sorry, I forgot I kind of have a limit with how much I could record in one sitting. I do also have to go to class in literally negative 2 minutes ago, but I wanted to finish the video. Other than that, ratio analysis, this is basically, oh wait, you want to see this decreasing, sorry, not increasing. Decreasing, that's about it. This basically just means how much debt do you have compared to your total equity. And if it's higher, that is bad. And if it's lower, that is good. So, for example, in 2021, Robinhood had a long-term debt to total equity ratio of 2,700. That is despicable. You don't want to see that. You can see here, like, long-term debt, not bad. Compared to, I believe it's common equity in here. Basically, you want to have more equity than your debt. I don't remember exactly how that's calculated or the ratio, but you do not want it to be super big. But anyway, that is the only really important one for the debt ratios. I covered decreasing debt earlier as well as the short-term debt. So in terms of the ratios, they are important, but it's not something that I specifically look into. But other than that, I think that is it. I don't really feel like doing a webcam outro because I have to go to class literally right now. But yeah, that's about it. Have a good one.